Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. Also, thanks to a new SEC marketing rule, I must remind you that there is no return guarantee when investing. All investments are subject to risk, and past performance is not indicative of future returns. So let's talk about the 4 things we learned in the markets this week on the final week of 2022. For a lot of us, that is actually a good thing from the stock market's perspective, that this is the last 2022 version of this. It was a mixed bag, especially for the good old Santa Claus rally that started last Friday on an up note. This week, one index we track was positive while the other 2 were negative, and just barely negative, putting the fate of the Santa Claus rally in the hands of what happens this next Tuesday and Wednesday, of course, with the market being closed on Monday. Now, I'm striking an optimistic tone for 2023 and saying, let's look for some good returns on Tuesday and Wednesday to close out the Santa Claus rally. Also, this is a nice time to remind you the points that I'll make today are for the last week of the year. But if you'd like to hear our thoughts on what happened in the markets for 2022, the entire year, watch our video, What We Learned in the Markets for 2022, which in the same format will give you 4 quick thoughts on the returns for the markets in 2022 and how we got to those returns. Now this week, our growth and income index, which of course is the S&P 500, was negative 0.14 for the week. So again, just barely negative. The Russell 2000, which tracks our more aggressive growth, smaller company stocks, was positive 0.25%, 0.25, the lone positive standout, after being slightly positive last week as well, if you remember from our video. And finally, the NASDAQ, which tracks growth stocks in our Dave Ramsey vernacular, more of the tech-heavy names, was negative 0.3% on the week. Now, point number 2. On Wednesday of this week, the National Association of Realtors released their pending home sales index. Now, this is an index of homes that are to be sold in the next month or 2 ahead based on signed contracts. The reading fell 4.03%, which put the index at 73.9 last month, down from October's downwardly revised 77. This month was the lowest reading for this particular index, other than when we had our COVID-19 induced drop, which of course just paused everything. So let's phase that out. And so this is the lowest reading since the National Association of Realtors launched the index in 2001. On a year-over-year basis, pending home sales are down 37.8% in November. The Midwest region has actually held up the best, where home affordability makes buying a home possible in this higher interest rate environment, where the West region saw the largest decline at 45.7%, where home prices are just bonkers, as some of you out west know, some of our clients on the West Coast. To some, this data might seem bad, and it certainly doesn't point to strength in the U.S. housing market. However, this lack of demand will continue to put downward pressure on housing and rent prices, which will be a tailwind for declining inflation in 2023. And that's a theme that the market needs, declining inflation. Point number 3. This week, the Wall Street Journal reported that the U.S., along with the group of 7 advanced democracies, the 27 members of the European Union, and Australia, have put a ban on shipping, financing, or insuring of seaborne crude oil coming from Russia unless Russia agrees to sell for $60 a barrel or less. Now, Russian President Vladimir Putin responded by putting a ban on the sale of oil to the countries that are taking part in this ban. Now, why does this matter to the markets? More specifically to the one thing that's driving a lot of market uncertainty, inflation. And it's this. If Russia sticks to this ban, and there's a whole lot of wiggle room for Putin to step aside on this ban, his own ban he created, if he wants to, it's going to put a major dent in the global supply of oil, therefore putting the price back up potentially and disrupting our lower inflation storyline we've seen the last few months. However, a disruption of Russia being able to sell oil at all to these countries will no doubt hurt its war chest and possibly its ability to continue financing the war in Ukraine. The Russia and its allies, for their part, are hoping that the lower price accomplishes two missions. They want downward pressure on the price of oil, and $60 a barrel will accomplish that. We've basically ended the year at 80. And two, it will limit the Kremlin's ability to deliver lots of revenue. They'll obviously get some, but lots of revenue from oil, their primary revenue source. We'll see how tightly President Putin sticks to the ban he just created, which says he's not going to sell. And point number 4, this week the Secure Act 2.0 was signed into law, and it makes some immediate changes to the retirement planning landscape. Now, let me just walk you through a few. First, and the one that most people, including us, have been waiting for, is the age with which you must make a distribution out of your IRA is now 73, which is an increase from age 72, and what a few years ago was 70 and a half. This is obviously because life expectancies are increasing, which is the same issue causing Social Security so many problems right now. Yet, unfortunately, nothing to help Social Security was actually in this bill. By the year 2033, the RMD will have been gradually increased up to 75. So if you're turning 72 next year, you don't need money from your IRA, count yourself lucky because you don't have to take it now. I should also note, if you're over the age of 70 and a half and you do any giving to a nonprofit, like your church through a tithe or another charity, you must talk to your advisor about the tax-free distribution you can take from your IRA to give to your church or charity through a qualified charitable distribution. Some other changes starting in 2025, the catch-up contributions, which is the extra amount of money you can contribute because of your age, will increase based on inflation. Also starting in 2024, employers will be able to give you your 401k match towards student loan debt to help pay off debt quicker, giving you an incentive to save while paying off debt. Now, I have many thoughts about this in relation to the baby steps that we help teach clients that I'm going to love to talk to Dave about, and we'll see how this impacts his advice. He's not going to listen to me, but I'll certainly make the case. Also, employers will have the option of making their match contribution on the Roth side of the equation instead of the pre-tax side that it goes into today. And finally, although there are many more changes, a 529 plan that you do for your kids can be rolled into a Roth IRA for the child if not used for school. So all those penalties you had, if you didn't use all your 529 money for Billy, can now be pushed into Billy's Roth IRA after a certain length of time, therefore giving Billy a jump start on his retirement planning if he did a really good job of making a great school choice in terms of the cost and or getting scholarships and or anything else he or she would have used to help bring down the price of college. So if the 4 points we brought up today were helpful to you, thank you so much. Do us a favor, hit the subscribe button at the top as well as the like button down at the bottom. That helps us with YouTube and Google's algorithms to help our content get to more people so that we can help more people live and give like no one else. Also, if you'd like to schedule a meeting for 2023 with any of the advisors on our team, the financial coaches maybe that help you get out of debt, stay out of debt, live on a budget, or the financial planners that actually help you execute baby step 4 and project all that out for you along with other financial planning opportunities, you can schedule a meeting in the comment section of this video, as well as we put a link to our blog, which is where we put some of our great written content that our advisors put out on a weekly basis to help you improve your financial situation. Thanks so much. We hope 2022 was a great year for you. It was a great year for us outside of the stock market, and we're looking forward to everything we can help you accomplish in 2023.